Hello and welcome to the latest Insider interview. Our guest today is Bryn Jones, manager of the Rathbone Ethical Bond Fund. Bryn, thank you very much for coming in.
Hi, how are you doing?
Very well, thank you. So what is the appeal of investing in bonds today, and how has that investment case changed over the past year and maybe 5 or 10 year investment period?
Yeah, I guess, if we go back to 2020, you were looking at very low yields. And everyone talked about the TINA trade. There is no alternative. So people were buying equities yielding 4 or 5%. Bonds were yielding close to 1%. And it kind of made sense for investors to invest in equities because over 10 years, you compound 4%, you were going to get well over 50% return. Whereas the bonds, are only going to give you about 10% return. So suddenly, equities you could invest in, they could actually fall in value and you'd still been better off in the equity market. So bond investing in sort of the 2020 and 21 suddenly become quite risky. But we've had a huge rise in yield. We saw big interest rate policy changes. In fact, the highest rise in interest rates since 2 years after the US independence, if you go back and look at proxies. And that meant we're now at a level where you've got starting yields that are yielding more than equities. And so suddenly investors can invest in bonds. For example, if you invest in a bond that yields you 7% over 10 years, you compound that return, it's 100% return. And so there's the first thing. The yields are more attractive. They're yielding more than equities. And for a more defensive asset class, that kind of makes sense for investors to have. But also as an insurance policy now, when bonds were only yielding 1%, you weren't really getting paid to have an insurance policy against your risky assets. Now you can invest in a portfolio of investment grade or government bonds or even a little bit high yield, and you've got an insurance policy against the other risk you take in your portfolio. So right now, bond investors are finding them more attractive, and normal investors, as in investors that are outside of the institutional space, are investing in fixed income because of those reasons.
And what is your investment universe and what types of yields are you getting at the moment, and how much does the portfolio yield overall?
So in the Ethical Bond Fund, which is our flagship fund, we have about a duration of about 5.5 years, and the yield is around 6%, give or take 10, 20 basis points, depending on what's happening on the day in the underlying gilt market. So you're getting a reasonably attractive yield with a fairly low duration risk. And of course, in terms of the assets we're investing in the Ethical Bond Fund, predominantly they're investment grade assets. So they are the higher quality, more defensive part of the corporate investment universe. So suddenly you're getting an asset which is yielding you very attractive levels with hopefully levels of volatility that are lower than equities and lower than high yield.
And that 6% is the yield to maturity. The distribution yield is about 5%.
Correct.
So investors looking for income are getting around 5% at the moment if they own the fund. Is that correct?
Correct, yeah. So the fund yields around 5%, which means that there is some capital appreciation tied in to the bonds. So the bonds in general are trading below par, so below 100, which means you'll get some capital appreciation as well. And the other thing is important to say about the Ethical Bond Fund is that we take our fees from capital and not from income, whereas a lot of funds out there will take their fees from income. So you're actually in a SIP or an ISA, you're getting a very good 5% yield on the fund.
There was a big bond market rally in the final 2 months of 2023. So what's the outlook for bonds now? Has a lot of the good news around interest rates and inflation already been priced into asset prices?
You're dead right. At the end of last year, going into sort of the end of October, the fund was up 2 and a bit percent. Going into the year, the final 2 months added over to 7.5% return. So the fund was double-digit return last year, over 10% return. And that was driven by expectations of policy changing from the Fed and expectations that inflation was going to fall quite aggressively, which led to the huge rally in rates market, but also pulled with it credit markets that were very confident that we were going towards some kind of soft landing. Some of that's repriced at the start of this year, and we're about half the way back up from where we fell in terms of both yield and spread. And that meant that now there is, again, a little bit more value. We did think going into December and looking at technicals that, pricing in 6 rate cuts and the earliest rate cut, right forward to March was a bit aggressive. And some of that's repriced now. For example, in the UK, we're only just looking over about 4.5 rate cuts for this year being priced into the market after December, where there were over six being priced in. So some of the good news is priced in. We think we're getting back to fairer levels, as we get to the sort of this part of January where we're at now.
Investors have been calling the return of bonds for over a year now. I remember at the start of last year, bonds was the most popular trade. It didn't quite work out that well. And as we start this year, there is a consensus that bonds will be a good investment in 2024. So why were markets wrong last year, and why are we right, or why are you right to invest in bonds this year?
Well, I mean, I would argue that perhaps that's not wrong. I mean, for most of the year last year, it was wrong to take that view about fixed income. But, the returns were 10% last year. So in a microcosm of fixed income, that's not bad. Whilst they may have underperformed the top 7 large cap US equities, they were still very good investments actually at the end of the day. So I kind of disagree with a 10% return from your insurance policy is actually quite attractive. The danger is that this year could be quite volatile. I don't think we're going to have a straight path. And again, we might go through periods where we see spreads widen and yields rise, which will have a negative impact on the underlying price. But ultimately, if you're getting a 6% yield, you're getting a lot of carry protection. So even if yields rise, so government bond yields rise 25 basis points, spreads widen 25 basis points, your mark to market, you haven't crystallized losses, but your mark to market might be off 4 or 5%, but you're still generating a 6% return. So your actual return for the year in nominal terms is actually positive. And this is the beauty about fixed income right now, because you have so much yield, you have so much carry, you're getting that protection. You're getting a protection of 6% every single year. And if you get some volatility, you're getting protected by that income. And that's why, I've invested in my own funds for that reason.
And what could cause bond prices to fall this year? What are you worried about?
Yeah, I mean, this is the sort of good news, bad news, good news. Every time we get sort of, the economy's slowing and, things are getting a bit weaker and inflation's falling. That's been very good news for bond investors. Government bond yields fall and credit spreads tighten because everyone thinks it's, central banks are on hold and going to start cutting rates, which is great for economies. The real danger is, though, when bad news becomes bad news. When central banks are having to cut rates because the economy is doing so badly. And I guess that's the biggest fear as a corporate bond investor. We can manage yields rising a bit. We can manage a soft landing. That's all kind of easy to do as a fund manager. What's really worrying for a corporate bond fund manager is a hard landing. How hard is that landing? How quick does it come? If we remember GFC and 2011 Greek debt crisis, when economies grind to a halt and bank lending shrinks and economies start to slow quite rapidly, unemployment picks up and businesses start to default. And it's that default cycle that really impact corporate bond fund managers. We can be a little bit sanguine about earnings. Equity investors, earnings event can hit equity share prices. We get an earnings event in the bond market, it marginally affects the price. It's capital events that really affect us. So my biggest fear for this year would be a real sort of nasty, quick, hard landing. I'm not saying that that's a probability, but that's the thing that we need to be conscious of.
Investment grade bonds are normally a sleepy, safe part of the fixed income universe, but this hasn't been the case over the past couple of years as rates have changed so dramatically. So is there going to be more volatility to come?
I think we're through the kind of impact on the price from the rates market. Rates going up. Will rates go up more aggressively from here? I doubt it. They may go up a little bit if we get inflation wrong. It's that credit component that we have to be conscious of. So, for example, if we do enter a kind of nasty slowdown, you want to be in your defensive, higher quality parts of capital structures. You don't want to be in deeply subordinated or high yield companies where they're looking to refinance, and because the economies are slowing, their earnings have collapsed and their spread, which is the extra risk that you need to compensate for taking those bonds, has widened quite aggressively, because these companies will be looking to refinance at levels that just doesn't make economic sense. And then they'll enter Chapter 11 or default or restructure, and as a bond investor, that's the dangerous area. So I think we are through the rates part. We just need to be very conscious, as I said, of kind of credit risk. And I guess the difference between 10 years ago and now is that you had much less gearing in companies. They tended to, whether you agreed or not with the rating agencies, tend to have a higher credit rating. And now there perhaps is more subordination and sort of more triple B issuances. Businesses have geared to try and increase their weighted, to increase their CAPM and their ability to generate excess return on equity. So they will gear a business to push up their return on equity. And we've seen a bit more of that kind of financial engineering in the last 10 years. So whilst investment grade historically has been very defensive, arguably some of the areas of it can actually be quite volatile.
Bryn, thanks very much for coming in.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.